today. So first one we had live down in London, which was nice because we could actually see people, hug them, etc. Second one we did in April, and there's so much happened since then you wouldn't believe. So today's our third one, and the main aim really today is to try and kind of catch up with what's changed and some kind of key topics. So forgive me, I am reading these out. So latest permitted development changes, biggest opportunity for residential developers now, because that's what you need to know. We've all heard about the stamp duties. That's ruled my life for the last week. So we'll talk about that. Future of commercial investors, really interesting what's going to happen in that sector. What to do when funding offers are withdrawn. I know that a lot of people have suffered with that. And how will the stamp duty changes affect the market? So we've got tons to talk about, but I do have to say, I'm going to introduce the guys in a minute, but the most important thing is wherever you're watching from, all we're really here for today is to answer your questions. So however you would put forward questions, if you're on YouTube, Property Tribes, etc., Facebook, ask your questions. They'll come through to me on WhatsApp, and I'll then be able to make sure that we get your questions answered today, because that's all we're really interested in, is helping you out during this massively tricky time. So now that we kind of got on and explained that a little bit more, we're going to go through. If I can actually find out, I've got so many screens on here, it's mania in this household. So just to introduce everybody. So our first person, and everybody knows the oldest in the group, one of the most accomplished property deal makers, because he's been around longer than everybody else, who has, and you are all going to be jealous, you can't be jealous of this comment, over 3,500 properties bought or sold in the UK have gone through this man, 3,500. And one of the latest acquisitions of John's portfolio was a £26 million deal, which was funded by Homes England. So you're in safe hands here with a guy that is trusted by all sorts of people. You can't always say that when you're talking about property investment stuff, making digs at anybody in particular. But next we have Paul Mahoney. Paul Mahoney is the founder and managing director at Nova Financial Group. Just to warn you, he does have a bit of a strange accent, comes up with strange phrases every now and again, so the delights of an Aussie on our hands. But he is an industry-leading property investment, financial advice. And what I would say is, we were sort of chatting earlier, and Paul knows mortgages inside out and backwards, but more importantly for you, he is also an investment specialist. So he's very unusual because he links the investment side, getting a return on the money that you have, but then delivers that through properties and mortgages. So really different to most people that you will deal with. And we have the most gorgeous fella on the list, Tony Gimple. If you don't, I'm sure I should be smiling at this point. If you don't, put your hands up if you don't like paying tax. So let's have a few hands up here. Yeah, Tony loves paying tax.
Absolutely.
So he loves paying tax because he didn't put his hand up. So Tony is your man, basically. He's a private rented sector commentator, speaker, but most importantly, advisor on tax and succession planning. And for anybody that read the press this morning and the possibility of a capital gains tax grab, you have not got a specialist tax advisor by your side. Please, if there's one thing you do after this call, go find one. Hopefully that'll be Tony, but if it's somebody else, you won't mind, will you, Tony? So really important. And then we have Richard Bush, CEO of Crowdlords. That provides finance to help offer landlords much healthier returns and investors, and rather than necessarily going out and doing the job yourself, you've got a professional organisation by your side to do it for you. So that's kind of everything we're up to. That's everybody that you've got, hopefully a good idea in front of you as to what they can make do to help. But as I said earlier, we're here to answer your questions. So what we're doing at the moment is just giving you a little bit of information just to kind of warm you up a little bit. So the first thing that I'm going to do, and this might be a little clunky, so bear with us, is I'm just going to give you an update on... sorry, I've got something here that... Right, I'm trying to press a button. I can't get to the button because something else has come up. So what I'm going to do is talk to you about where we are economically, because this is definitely going to impact on what happens into the future. So hopefully by some miracle of technology, albeit a little slow, I'm going to be sharing my screen with you. So I can't see anybody else now. So can somebody shout to tell me you can all see that?
I believe we can see that.
Yes,
Yes, we can see that, Kate.
Yeah, all up.
Marvellous. My
Go for
biggest
it.
fear of the next 2 hours is now over. So what is the latest on the property market for July 2020? Huge amounts has changed. So when I presented this before, back in April, then everybody was fairly confident this was going to be what we call a V-shaped recovery. And you can kind of see that from the scenarios. I'll explain the side in a minute. They were thinking this was going to be over in a year, 6 months, and we'd all be back to normal and everything would be fine. The kind of realization has sunk in that that is not going to happen. And what you have in front of you here is the orange line shows this is basically GDP. And if you think of it just as GDP is a measurement of how the economy is doing, they were expecting it to grow to by about 8% over the next 5 years. And that might still happen on the upside scenario. This all comes from the Office of Budget Responsibility, so it's what the government and various other people use. So we might get that, but we're not going to be anywhere near there until, or heading back to that line until kind of 2022. So before we were looking at a year, now we're looking at 2 to 5 years recovery. The central scenario, so that's sort of hedge your bets a little bit. We won't have an upside. There won't be a horrendous downside, and we'll be growing at around 5%. And again, that's going to take a little longer. So you're talking about 2 or 3 years being in a pretty sizable recession. And the real downside is if things go absolutely pear-shaped, it could be another 5 years. And if it is 5 years, that's kind of where we were, and you'll be living through what we had to live through during the last recession, just to give you a little bit of an idea of what might come up. So I've given you these stats and figures here. So basically what you've just seen is the first line, GDP. The bit that's important to you is inflation. So that's the second line. And what they're really suggesting is that inflation is not going to be a huge factor over the next few years, despite the money that's being poured in. They're expecting inflation to be pretty low. The reason that's good is because if wages can keep pace with this 2% growth, then that means rent will like stay the same, so you won't lose money. Where inflation goes higher than people's wage growth, that's when you. The other thing that's incredibly important is that unemployment rate. So the top bit you've got is the central scenario, so that was the middle one, and what's really spooking everybody at the moment is the real fear of massive unemployment starting from October when the furlough scheme ends. So you can see on the central scenario that they're expecting that to double this year. They're expecting, and this is the bit that's different and why they're expecting us not to recover as fast as possible, that it will rise even further throughout 2021, and then it will take a lot longer to come back. So implications of unemployment. How many of your private tenants, for example, are going to be made unemployed, and have you got insurance that will cover it? Important to check that, and important if the insurance company will pay out. Some of the rent guarantee ones I don't believe have at the moment. So you've got to think that if your tenant goes bust effectively, what have you got in your armoury to protect your funding, because you still aren't going to be able to get very fast, and don't know what support the government's going to give. So those are kind of things to look at, but we are expecting to be in this for a good years. You've got to basically make sure that you're protected throughout that time. I put the chart in on the unemployment just to show you how absolutely scary that is expected to be. Often what you find with forecasters is they kind of underrated or under suggested how bad this was going to be to start off with. I think they may have gone too far to try and kind of protect themselves and got too worried. So somehow that's sort of somewhere between the upside and central scenario. I am quite an optimist, so I will point that out. At the moment is likely to be where we get to. From a property forecast side, Savills have kind of come out with the boldest of forecasts on what's going to happen in the property market. might look at that and say, right, so this year they're expecting all prices for all properties in every single region to fall by 7.5%. And that is quite blanket for me. I'm not sure. I'm a big fan of Savills forecast, but I'm not sure that this is going to be right.
No.
The central one for 7.5% may be correct. London may fall less. The northeast is actually the most interesting in that it might not fall that much because it's already 9% lower than it was 12 years ago. So you've got to kind of look at these. But the interesting one, bearing in mind most of you will be in for this for the long term, is that if you look at the end of this chart, you've got in yellow 5-year forecast and in orange the 5-year forecast. Basically, what Savills have done over the next sort of 4 or 5 years is said that based on their forecasts last year, they're not expecting the 5-year growth to be that different over a 5-year period. And that's probably about right. That's about as best guess as we can make at this moment. But you can see in London that's actually looking over a 5-year period at a 4% growth rate. My view on this is totally ignore averages moving forward. It's all about individual prices. I think some properties won't fall in value at all, and I think others will fall by about 20%. And you've got to work out which is that category. Currently, we are seeing some really damaging stats going on in the news, and I think that's partly because they want to say that, but it's not. It is buzzing out there, and it's buzzing even more now that we've had the stamp duty cut. On that, just bear in mind, and Tony, just pick me up on this if I'm wrong when you have your chat, but Wales doesn't look like they're going to allow any concessions at all for investors like Northern Ireland, England, Scotland. But here's where it gets really interesting. Home Track, another organisation I rate, they're actually looking at house price growth up 2.5% year on year. Sales agreed, and this is really interesting, 4% higher than pre-COVID. And that's despite having Scotland, Wales and Northern Ireland closed. We're expecting a rebound, obviously, in that activity. And on the back of this, despite the fact we all know we're going into a massive recession, and we all know that prices have to fall for some properties, they're still predicting a 2% price rise, which is why if you thought you were going to get a ton of deals and you're going into agents, they're probably not that interested. Nationwide and Halifax data has been used and published. I just can't see how that can be accurate with the little data that they have. So really, my message is focus on your local agents. They are the only ones that know what can help.
Okay. Well, I've got 5 estate agencies in Norfolk, Fine and Country, which is a good brand, and it's more of an upmarket brand. And what we're seeing, we're super busy at the moment. And what we're seeing is people who are thinking of moving in 5 years' time, perhaps, up to Norfolk, Suffolk, Norfolk, are now doing it immediately. And I think they're doing it before the next lockdown. They want to get on with it because they feel there could be another lockdown. Who knows? They realise they don't need to work all the time from the office. They're going to be working 1 or 2 days from the office, maybe not at all working from home. And I think what this will do, Kate, and it may upset a few people who live in Romford and all around these areas, but I think this is going to balance up the property market, because if you don't need to live, with all due respect, in Romford, Hornchurch, all these types of places just on the edge of London to get into London, then you can live in beautiful Suffolk, beautiful Norfolk, Lincolnshire, Wales, wherever you want. And of course, the prices are half price. Well, now, they're going to go up, obviously, and we're super busy, and we're already seeing gazumping going on and all sorts of things in Norfolk. So now this might be only short term at the moment, I accept that. But I think people are looking at a quality of life. They want a better quality of life. They realise that they don't need to be in London. Of course, young people want to be in London and with the vibe and everything else. And people will want to still go to the office 1 or maybe 2 days a week, maybe. But I mean, I've got a lot of people of my age, 38, 39, that sort of age, who are now,
your nose is growing, John.
Yeah, thank you. Who are now saying that, you know what, I don't need to go to the office at all, John. So that's all changing. Now, I think personally we'll have a good run till about November. I don't agree with Savills. I don't see, and we know, and Paul's always saying this to me. And if there's one thing I've learnt off Paul Mahoney is two things. Well, two things. One, he's got 2 degrees, which is unbelievable as for an Australian. And the second thing is that it is a micro market, and he's absolutely right. So, you know, in Norfolk, we are seeing prices go up. We're not seeing prices go down at all. And this Savills, you know, 5-7% drop or whatever this year, I'm not seeing that. I see a bigger drop next year in certain areas, but I don't see that at the moment.
Yeah, no, that makes sense. And have you seen just over the last few days with the impact of stamp duty? Have you seen much with that?
Yes, I think that's given people more confidence. I mean, at the end of the day, stamp duty is a tax on mobility. It stops people moving around the country, and I don't think this tax is going to come back in the same form again. Under 500,000. And as for Rishi saying, oh, it's only till March, he's having a laugh, isn't he? It's going to be for 2.5 years. There's no way it's just going to be till March. We're going to be in the mire next year and the year after, and they're going to need all the support they can get, property people are, to get the country going. Because as we all know, when you buy a property, on average, people spend 5% of the value of that property refurbishing it, improving it. You know, carpets, curtains, kitchens, all those things, and at least this government have realised.
Yes,
they're not always that bright, but they've actually realised that the property market is essential to the UK economy, absolutely essential.
Yeah,
and
I also think it's
that.
confidence. It's the confidence of consumers. If they're confident enough to move, they're confident, like you say, to spend money, and that is half of it. So I agree with that.
Yes.
So that kind of looks at the resi side, but there may well be others very nervous at the moment, sitting on commercial. Where
oh my goodness! I've got 3 shops in Colchester in a row, and not one of them's paid me. Not one of them.
Wow.
My bigger tenants are now paying again, so that's great. But my smaller tenants, forget it. I mean, luckily my pockets are relatively deep, and we can live with it. But we've got no commercial rents coming in at all, hardly. And I don't see that situation change at any time soon. I was disappointed, Kate, that you haven't mentioned about my haircut I had this morning, because I went to Ipswich first thing, 8:15 my appointment was at the hairdresser's. And I drove into Ipswich and no one is about. I mean, no one is about.
Yeah.
And that's typical of most towns. Now, I think market towns, the smaller ones, are going to survive relatively okay. They get support from local people. You can drive in, you can park easy. The bigger towns, the cities, we are in for, I believe, what's happened in the last 4 months has moved us on 10 years. 10 years. People working from home, as we've said already, not wanting to go to the offices on a regular basis. I mean, you've got a coffee shop in the middle of, I was in Norwich the other day. I was in Norwich the other day, and if you've got a coffee shop in Norwich, there is literally no one about. You know, no people aren't shopping. They're just not going into these city centres because they rely on all the office workers, and the office workers aren't there. And I think it's very, very serious. And anybody who thinks they're not affected, probably is being naive. And the reason I say that is because if you've got a pension of any sort at all, guess what these pension companies, these insurance companies have done? They've invested it in office commercial property, offices, and they've invested it in A1 prime commercial. And both those are going to go down at least 50% in rents. And to give you an idea of that, just to put it on a more sensible level, if you bought a property for 500,000 and it's a vacant office, say 500,000, you got a tenant for £100,000 a year, you'll be thinking, you would have thought you're super clever, and you would have refinanced that and borrowed probably 750,000 on the basis that it's worth £1 million because you've doubled the value of it.
Yeah.
That tenant's gone bankrupt. You now can't rent it for 100,000 a year. You can't even probably rent it for 50,000 a year. So, you know, if you borrowed 750,000, it's now back worth 500, or worse still, 350,000. You're what's called underwater. And that is a very serious situation for a lot of property investors. Very serious. Insurance companies, I haven't got so much sympathy for because they're large and they'll survive. But of course, I feel very sorry for all those people who have invested into those pensions, because they will be seriously affected by this. Anyone who's got a pension, on the whole, will be seriously affected by the commercial property market.
Well, we are going to talk about that in a little bit as well later on, because there are still some options that might not be quite so doom and gloom for you to kind of rush off and think the world's going to go to pot. So there are still some opportunities. And do you think, I know you're kind of quite close on the government side of things, the plans that they've got so far, have they got them right? Should we have confidence in those? What else would you like to see them do?
Well, I think obviously everyone loves Wishy. Anybody giving money away, everyone loves them, don't they? So it's very easy to go giving the money away. The way they've given money away and the speed that they've given money away, I think has been very clever and very good. I don't think anyone can complain. In fact, you could say that they've been too generous, in my opinion. There's a lot of, I think, people taking advantage. The bounce back loans, I know a number of people with bounce back loans who've decided they're going to buy property with it, pay the school fees with it and all sorts of things, but that's up to them. Of course, don't forget, it's all great at the moment, and I described it the other day like an energy drink. So the government have thrown everything at it. Everyone's running around on this cheap speed, as we call it in the racing industry. It's called cheap speed. Running around and no problems. That is until next March or April when they start paying the loans back. And so next year and the year after are going to be very serious. And I think employment, goodness knows what it's going to go to. Nicholas Walworth's going to be gutted because Harrods have just got rid of 700 staff. So all those personal shoppers he used to go when he used to go in, he used to make a fuss of him. They've all gone probably. 700 staff in Harrods alone gone. I mean, these are big figures. And I know friends who have got businesses who are doing very well, but have still decided to get rid of 20, 30 people because they realise they don't need them anymore.
Yeah.
So it's not just big companies.
That always happens in a recession.
Always happens. Of course. Absolutely. Always happens.
You always have a bit of a clearer. Brilliant. Well, John, thank you very much. Somehow we've actually managed to do that in 10 minutes, which I think is a first between you and I, which is quite cool. So I'm going to head over now to Paul. Paul, maybe if I could run a couple of those dying mortgage questions that we all want to ask, and then we'll talk more about the kind of investment side of things.
Yeah, of course.
So current LTVs for loan to values for buy-to-let investors, and perhaps have a chat at the rates. And I suppose my big question, are rates now at the absolute bottom? In which case, even if you're paying a little bit more for a house, that might not be such a bad idea if your cost base is quite low. Could you perhaps address those, and then we'll talk about...
Yeah, absolutely. Yeah, so the mortgage market sort of post-lockdown has bounced back really quickly, surprisingly. Obviously, things kind of came to a halt at the start of lockdowns. Valuations weren't able to happen. Most lenders now are kind of back in full swing. Valuations are occurring. I personally had one done yesterday. Lenders have bounced back with good rates, some at better rates and better loan to values than pre-lockdown.
Wow, okay.
Which again is surprising. I think so I think it's a good example actually of how the media can mislead people sometimes.
Yeah.
Because there was lots of negative media. Well, a lot of the time, obviously, there was lots of negative media at the start of lockdown about lenders no longer lending at high loan to values. And I think a lot of it was based upon Barclays and Lloyds scaling back. But they're the last people you want to borrow from as a landlord. They're the strictest lenders. That they only want to deal with the A+, borrowers. And most landlords don't fit in that box. Or the properties they're buying often don't fit in that box. So that wasn't the case. And I was constantly having to reassure people about that. Don't worry, the mortgage market is just on pause at the moment. It hasn't pulled back from the market. And that has luckily proven to be the case because it's bounced back really quickly. Obviously, the Bank of England rate is the cheapest it's ever been. However, I don't necessarily think that rates are the cheapest they can be because most lenders haven't passed on that cut in full. And I suppose potentially part of that is they've built in a bit of a risk buffer for themselves. Yeah. And perhaps that's why they still do have a very strong appetite for lending because it's more profitable for them.
Yeah.
So I think it's a good thing. Lenders seem positive about the market. They're lending at the high loan to values again, as I say, some at higher loan to values than they did previously, at quite good rates. So that's a positive sign, because, you know, as you quite rightly say, Kate, even if you're concerned about slight price movements over the next 12 months of, you know, let's say up to 5%, I still think if it's a good property in a good area, you're best off buying it now, because if you're buying it for a 5 to 10 year time frame, that potential saving of 5% could actually end up being a potential loss of 5% as well, because as everyone just quite rightly said, the market's doing really well at the moment, and it's only speculation as to what's going to happen over the next 12 to 18 months.
Yeah. So that kind of leads into another good question then. So in your mind, bearing in mind the economic turbulence we have coming up, which is beautifully explained by John, then how do you assess somewhere that is safe to invest? What's safe to you?
Yeah, so again, I agree with what you were saying in your talk, Kate, with regards to the main concern being around job loss, and then how job loss will flow on to property, or demand for property, I suppose. Now, I think most people will agree with me that the areas or the locations that you'd be most concerned about will be locations with thin job markets.
Yeah.
Smaller cities and towns in regional areas around the UK, where they're quite often driven by one industry or even one major company. Now, that's a concern, because if that one industry or one company shuts down or scales back or moves away, you're in trouble. Whereas if you're investing in a large city with a broad range of industries and employers and much deeper employment markets, then you can obviously have more confidence that the gaps will be filled.
And do you think that still holds true, bearing in mind that John's comment as well about people maybe moving out of the cities?
I think it does still hold true, and I see where John's coming from in saying that, and I think perhaps this, you know, certainly with John's generation, they would have that in mind.
Oh, that's not.
No, and this isn't a jab. This isn't a jab. This is the truth.
How long it would take?
This is the truth.
No, I'm not
having a go at you about being old, John, even though you are getting on ages. But
hold on, Paul. What I think. Actually, though, what I'm just listening to what you're saying and what John's saying, and cutting out the bits, the sarcasm in between. What of course we're talking about is buy-to-let investment, and where we are, people are moving out. It is those people that are buying homes as opposed to those people that are renting them. It's you can kind of, what I think is helpful to people is there's so much noise coming out of property from the media. It's trying to be able to read that information that's useful and throw the stuff away that isn't. So I see where you're coming from, and the idea. And
I do think, you know, I wasn't having a go at that, John, there, because I do think it is a generational preference, in that older generations, first off, probably are a bit more wealthy, and therefore have a bit more attraction to buying a stately home further from the city. But secondly, earlier on in life, they were more family focused. You know, they had children earlier, they got married earlier. The dream was to have the large family home. Now, I think probably from kind of my generation down, that's not so much the case, because the focus
that would make you about 24 based on what
based on
what John said earlier.
Yeah, you know, I think people are working longer hours, they're having children later, they're getting married later. The focus is more on having facilities and amenities on your doorstep, and not so much on having the larger family home and travelling an hour to and from work every day. Now, I think that there will be a change due to this work from home situation, which I think will continue on in a much greater form than it did previous to COVID-19. But I think the main way that will impact younger professionals' preferences will be toward more livable properties, you know, larger floor plans, facing the right direction, dual frontage, all that sort of thing, which makes a place nicer to be because they're going to be there more often. And therefore, potentially, the cheaper, older, dingy properties that previously rented really well because of their location may not so much anymore.
Yeah.
So I think that's one of the ways that this will affect things. But I do think there's been a long-term trend toward inner city living, You know, an example I quite often give of this, and I think it's a good one, is the Manchester city centre 20 years ago. There was only 1,000 people living there.
Yeah.
It was all retail and commercial space, and now there's 30,000. So that's a huge trend that's happened over 20 years. I don't think that's all of a sudden going to reverse because of the situation we're in now. I think it will just shift it a little bit.
Yeah, so you'd be looking at, if you're looking at flats, it would be flats with communal gardens, outside space, a shop
facilities,
on site,
yeah,
maybe that kind of thing. So having the amenities close by.
Kate, sorry, very, very quickly. I did say that younger people will want to work from their offices in London. You know, in London, they will want to work locally in London. They won't, because they like the buzz and everything else. And it is the older type of person, to be fair, who will be moving out.
Yeah, and I think what you're highlighting as well is the importance of really understanding your target market. Who is it you are going to grab? And really, you've got to get that right. If you get your proposition and your target market mixed up, there's nobody's going to look at. You're not going to ride the market over the next 12 months. You're going to fall off. So,
I think that ties back into your question quite well, Kate. Is the way in ensuring you're absolutely safe is by buying and owning very rentable properties, regardless of the state of the economy or the climate, the political climate, all that sort of thing. If your property's rented, you're safe.
Yeah.
And in my opinion, the easiest properties to rent are centrally located, desirable properties close to lots of employment, facilities and amenities. They'll rent every day of the year, even in a major recession.
Yeah.
And therefore, they're a bit more sustainable.
We have amenities here.
Okay, sorry about that. I'll learn your language one day.
Let's hope so.
So we've not just got COVID. There's a little thing that we haven't spoken about for a little while, and everybody's going to groan when I mention it. But it's starting to come over, which is, as John has kindly interrupted me for, Brexit. So Brexit, COVID, how on earth are those two going to kind of collide and a landlord still be successful moving forward?
Yeah. Oh, look, I think it's a good progression of what we've just been talking about, because the concerns around Brexit are somewhat similar to the concerns around COVID-19 in that, economic instability. It's all kind of the same thing. How they collide is anyone's guess. Whether Brexit is short-term bad and long-term good, or vice versa, or it's all good or it's all bad, no one really knows. But it's happening, so we have to deal with it. And I suppose, again, my view on that doesn't change too much from what I've just said, is if we're investing for the mid to long term in what John referred to before as microclimates. Yeah. My phone. Okay. What John referred to before as microclimates with strong individual driving factors that are somewhat external to the overall property market. Because, we looked at the prediction before of the UK property market. I think that's almost irrelevant to an individual landlord.
Yeah, well, almost misleading, isn't it?
Yeah, I think so, because none of us, regardless of how wealthy we are, we can't buy the UK property market. Yeah. We can only buy individual properties in individual areas, which are driven by individual driving factors. So, I can give some examples, but I don't think it's all that relevant. Focusing on areas that have, strong infrastructure spending, strong job growth, really strong reasons for people to want or need to live there, and that moving in the right direction, creating new things, positive growth and change. All of those things give more confidence in performance, regardless of the overall market. And that's the type of things that we look for.
Yeah, and I have to say, Paul and I have worked quite closely on a couple of projects, and it is the bit that I think is missing in the property sector is the link to finance. So people are very good at training you on doing deals or making money or all this, that, and the other, but there's no point doing that unless it meets your financial objectives. Yeah. At the end of the day, you've got a pot of money, 50 grand, 100 grand, 150 grand. The biggest mistake, and you cannot afford to make this over the next couple of years, is investors and landlords that don't say, I've got 50 grand and this is what I want to deliver with it by when. And the lovely thing about working with somebody like Paul is that he will help you from that early stage and help you then understand how to deliver it. And then you've got people like John, Nicholas and Richard who can help you look at different ways of doing it, as well as another ways other than buy to let. So it is really crucial. And the other thing, just to build on Paul's point, is when you're looking and thinking, well, how do I find these safe places? The best way to do it is start off in your own area. And if you go and look on the sold property price data, which is freely available on Rightmove, Zoopla, the Land Registry, one of the things that I always look at is if I'm looking at buying a property or selling a property, is you've got individual house price data by road going back to 99. That's over 20 years. And what you can see is if you have a look between 2007 and 2013, have a look to see how well that property performed, because some crashed by 50% and some haven't recovered still, and some only crashed by 5 or 6%. And what Paul's referring to is go find those 5 or 6% falls, because they're the kind of safe houses on good roads, and that's not going to change, isn't it? I think that's what you're saying, Paul.
I think the only caveat I'd say, I agree with everything you've said there, Kate. I think the only caveat I'd put to that is places like Birmingham and Manchester didn't fare that well in the last recession, but they are substantially better locations than they were then now.
Yeah,
that makes sense. They're more robust cities now than they were 10 years ago.
Yeah, no, I think
that's
that's
worth
fair.
Considering too.
Yeah, that's true. Thank you very much. Right, we're going over to the hold your excitement here, because we're going over to Tony now to talk about and I know the others will agree that all our presentations are important, but guys, if you do not get your tax sorted out in the next few weeks or months, you are going to get raided. You've heard it here. I started talking about this back in 2005-06. People thought I was a bit of a nutter, but I was right then, and I'm absolutely right now, and I'm only telling you because I'm trying to protect you. So, Tony, I guess the first question is, we've got a bit of a tax break, which hasn't happened for about 10 years, and that's with the stamp duty thing. So is that really great for investors, or where do you sit on that, and what do you think will happen? Will it extend beyond March 2021? Because that's the first question.
I think it will extend beyond March 2021. To have the stamp duty threshold, whether you're a residential buyer, whether you're running a portfolio landlord business, whether you're investing in resi property, then not having to pay stamp duty until you get to that $500,000 barrier can only have highly positive outcomes. People will move, money will move around society. As John rightly said, they'll be spending 5% of the property value, on all of the refurb, all of the other taxes. And the big issue, I think, is to stop treating landlords as barely one step removed, from living off immoral earnings.
Yeah.
I've probably over the last 5 years must have spoken to 5,000 different types of landlord. You probably count on the fingers of one hand how many of those were a little dodgy, maybe.
Yeah. Well, I mean, I say to people, and I must admit, I get absolutely slam dunk for it, but I've met people who are nurses, doctors are always big landlords, people in the armed forces tend to go into being a landlord, priests, because they live in properties and they have nowhere to that basically come as part of the church, whatever they're looking after. And I get so slam dunked for saying anything like that, but it is true. And I've tried very hard to get people away from this anti-landlord thing, but I have to say that it is still an agenda that everybody wants. And I think a lot of the time it's so that the government isn't taking flack for its policies.
Well, the next election is 4 years away, something like that.
Yeah.
So, and whatever happens, government will take flack.
Yeah.
You've got some real, structural issues here. In that we haven't had enough house building since the war. Demand exceeds supply. So things like stamp duty, treating the market more fairly, getting the population, back to social mobility, has to be the priority of the day.
Yeah.
Brexit, for Pete's sake, we're a maritime trading nation. You know, people are still going to come here regardless of whether we're in Europe or not. We're at the crossroads of the world. Yeah,
Yeah, and I think that's been quite proved, because we've got people like Nissan staying, and lots of other organisations that, and what was the other one? My old place, Unilever, they're looking at taking the Dutch, bringing it over to England. So there's a lot of positive stories, but again, they're not being reported that widely, I don't think.
Well, you know, I suppose we could go on about, you know, the way that the press has become the opposition and that it's drifted somewhat left of centre. But that's not the point of you know, today's webinar.
So talking about what the state's up to, obviously it's put all of this kind of money in, and that's going to have to be clawed back. We've seen the headlines this morning that they're looking at they're reviewing capital gains tax, and that's why I'm saying you've got to talk to a tax expert now, because that's pretty potentially scary. Do you want to highlight what was being proposed at the last election when they were looking at matching capital gains tax rates to income tax rates?
Well, is a capital gain an income? I don't think it is. You know, it's a gain based on either active or passive speculation. You know, the one change there should be is when it comes to how HMRC treat dividends. Dividends are income. So to have a lower rate of tax for dividends when you're working in that business, as opposed to just being a passive investor, is crazy. It is outdated. So you've got a situation where it's blown back, in that if you're running a company, you're taking dividends, you're doing so to minimise your personal taxation, you're finding it harder to get a mortgage. You can't get government support. You can't. You know, you effectively not going to be able to furlough yourself. So there are all sorts of inequities just within paying less tax on dividends. CGT, you've made a profit through something outside of your control, and it's just another way that the government can help balance the books. We're hearing some chatter on what government might do about inheritance tax.
Yes, that's quite a critical one, isn't it?
That is a critical one. And to suddenly levy inheritance tax on trading businesses, well, it'd be turning the clock back 100 years. Why on earth, or wealth taxes generally, why on earth would you take all of the risk of building a business only to see it pass out of your hands, or during your lifetime to be taxed? Because again, you've been good at what you do, created employment, helped others pay tax, and suddenly you're getting stuffed on a wealth tax.
Okay, so just let's bring it so as a practical note to those on the call at the moment, in terms of what's the minimum sort of tax and planning stuff what are the three things that they should have in place, and if they haven't got in place now, get in place straight away.
All right. One, they need to have in place, if they're in property, which is, I guess, why they're listening to this webinar, is to have a specialist property accountant who can look forward and not backwards. That is the number one thing. Right. Number two, look at areas that are going to give you good yield on your property, i.e. rental yields, not speculation yields. Do the job properly, and then talk to the accountant about how best to structure it going forward. Make prudent provision for what your tax bill is going to be.
Yeah. And what about things like wills and trusts?
Well, estate planning, succession planning, everyone's going to die. Fact. Yeah. 2/3 of the adult population hasn't bothered to write a will. Even a higher percentage doesn't have a power of attorney for their property and financial affairs, let alone their health and welfare. So if nothing else, do a simple will, leaving everything to each other. If you're married or in a civil partnership, try and spend it all before you go. But if you can't, look at it in the round. Again, bring the whole thing together, the property portfolio, your personal circumstances, appointing somebody to speak and act on your behalf if you can't, not quite dead, but not quite alive. Don't try and do it yourself. Don't shop around purely on price. It's not what it costs, it's what it buys you. Yeah. Meanwhile, the stamp duty stuff, buy whilst you can.
Yeah.
Don't overly rush. In rural Sussex, where I'm fortunate enough to live, we've seen a lot more properties come on the market. Prices are actually rising, not falling. The local agents are as busy as anything, and you're seeing properties that were over the $500,000 bracket now coming down, and the ones that were under it actually going up.
Yeah.
So it's a very strange position.
Okay, that's great. And as I say, one of my biggest frustrations when I'm on social media is the amount of investors and landlords that post, please can somebody help me with, have I got my CGT calculation correct? Should I be in a limited company or should I invest personally? Please can you tell me? Nobody should be posting yes, no, whatever. Every single post on there should be go seek specialist tax advice. Yep. And if you don't, I'm really sorry, but you are going to get caught out because the government is going to have to get somebody to pay for all the money that's going out, and they will come after you first. You're going to be at one of the top of the list. So it's really...
Join, it looks like everyone's still on, so that's good.
Great. Thank you for staying. Thank you very much for staying with us. Apologies for the technological problems. So we're talking to Richard at the moment from Crowdlord, and I was saying that Richard is literally got people's money and investing projects in today's kind of scary, merry world that we live in at the moment. So if you've got projects that are lined up, accepted by the vendors, for example, and their lenders withdraw for any reason, what sort of advice and help can you give, Richard? Because you're dealing with this day to day.
Kate, before I answer that, just to address the point you made about it being a scary moment, I think one of the things that everyone agreed with earlier is that there is no market. So whilst on average there is an issue, every single project or every single town or every single property is in a different environment and is facing a different challenge. We've had projects recently where after the lockdown, they've sold quicker than they were selling before the lockdown.
Wow.
Where we go with the idea of property prices crashing by 7.5% across the board. So I think we're all agreed that, there is no market, that there will be challenges, but those challenges are very specific to micro market. Even individual properties in individual towns is not an average. And so I just wanted to make that point.
No, you're right. You're very right. I think for me, though, it's still, for somebody like you that's highly experienced, you know how to address these things. But for those, this is still scary, whatever they're doing. But you're right. The point of today is to help navigate people through, help you out there through what's going on. So completely take your point. But for quite a few of us, it's a little scary if we haven't got.
It is a little scary as well for us. Like you say, we are responsible for people's. We're not responsible, but we have enabled people to invest their money into projects that we've arranged. So we do take it very seriously, and we monitor every project very closely as a result. But coming back to your question about people that are in the middle of projects, about to start a project, and they've had the offer withdrawn. I can completely understand why some lenders have done that. It is that, like we've said, we don't know what's going to happen next year or the year after, and they're just being prudent, and they're being cautious, and often not by their own choice. They're being cautious because their funders are no longer allowing them to lend their money. Every lender gets the money from somewhere. And so across the board, there's uncertainty, and so people are being more cautious. Especially, what do you do if you're a landlord about to buy a property, or you're a developer about to buy a project, and you've had your funding withdrawn or lessened to what it was? It might have been they were offering 75% loan to value, they're now only offering 60%. So what do you do? And I think the first thing that people should do is to reassess the project. It is an opportunity, given that the purchase hasn't yet happened, to reassess the project under the new environment, under the current environment, and what's predicted for the next year or two. And it might be better to walk away. You know, developers and landlords don't like walking away from projects. Rather than trying to make it work, something that doesn't work, trying to make it work. So it could be an opportunity in that respect. If, having reviewed it, you still think it's a good project and you still want to go ahead, then I guess the challenge is, how do you make it work? How do you make it work when you can't borrow as much as you were looking to borrow? And it could be that you reassess the project. It might have been a house that you were converting into HMO. Given that the lower income market is the market that's going to be hit hardest over the next year or two, it might be better to change that HMO into 3 flats as opposed to sell them. So you might change your strategy based on, triggered by the lenders changing in heart. And that change in strategy might change the lender's assessment of the deal as well. So it's good to understand why the lender has changed their terms, and it might be that you can still make it work. However, you know, you can't make something, what's the expression about lipstick on a pig, it's still a pig, whatever it is. You know, if it's a bad deal now, it's still a bad deal. And so if it doesn't work, it's best to walk away. If it does work, then you can always find additional finance from somewhere. It might be that you go to friends and family and you boost your own capital, so you need to borrow less. It could be that you come to a platform like ours and you look to raise some debt or some equity so that it can go ahead. Or you might simply try new lenders. Some lenders are still offering 75% loan to GDV. Others are now down at 55%. So, you know, at the end, there's always an alternative that you can find if you look around.
Okay. And I guess moving on from that, in terms of investing in a platform like yours, for example, rather than going and choosing your own project to invest in, sort of is this a better time to do that because you've got somebody else looking at this project for you, or particularly for the first time investors, I think?
Yeah, that's an interesting question, Kate. I think my recommendation to all our investors is we've done our due diligence, other platforms have done their due diligence, but do your own due diligence. So it's not, I would never suggest to people, go onto a platform, trust what they're saying, take their assessment as being right for you and make that investment. It is down to you to determine whether it's a good investment or not. That's the most important thing. Having said that, one of the advantages of crowdfunding and peer-to-peer lending enables you to diversify. One of the things that we've talked about earlier is how there are micro markets, and you know, one end of the street might go up and the other end of the street might go down.
Absolutely.
One advantage of this method of investing is it allows you to spread your risk across multiple towns, across multiple regions, across different types of investment. And you couldn't do that on your own. If you've got £50,000 to invest, you've got to choose which property to invest that into. On a platform, you can spread that across 10 investments, and therefore you mitigate the impact of any downturn or upturn. So that's probably the biggest advantage of using a platform like ours in the current market.
And what do you think are the kind of top 3 due diligence tasks that people should be doing when they read a pack?
That's a really good question. I think I'm not a fan.
I don't just ask easy questions.
No, you never ask easy questions, Kate. I wouldn't like to say top 3 because it depends on what it is you're investing in. But I think what you need to look at is the local market. Because as we've all said when we've talked about where we're going to buy or what we're going to invest in, it isn't a national market or a regional market, it's a local market. So wherever the investment is, look at that market, look at the investment that Paul talked about, look at the employment that we've just discussed. You know, if it's in the middle of Derby and we know Rolls-Royce have just laid off 7,500 people, is there enough employment locally to make that still a property that you'll be able to rent?
Yeah.
Understand the local market. And then understand, I think, the financials within the investment. So, you know, some people work on a 18% margin on developments, other people 25%, other people 35%. Where you have the greater margin, you have more room for things to move and you can still make a good profit. So I think it's about detail as opposed to taking general comments from people like us that are generic and are not specific.
Yeah.
If you do your due diligence, it has to be very specific. for that property and that investment in that town at that time.
Okay. And I guess just sort of with your wider experience and stuff, when you're looking at projects, are you changing your kind of criteria from, I suppose, a social change perspective, for want of a better phrase, in terms of, you know, if you're just building flats and there's no communal gardens, you ain't getting anything now, and you know, where are you? What criteria are you starting to change, putting more value to? Perhaps would be a good.
Yeah, I think it's you know, I've read a lot about social change, and we've talked about people now working from home. Everyone's moving to Norfolk, apparently, according to John. You know,
the facts. They're the facts. I can't help the facts.
Or Ipswich. They're moving to Ipswich as well.
Social change, and you know, whilst we all have a view on what tomorrow will look like,
they're coming for you.
Police are coming. Yeah, absolutely.
Yeah.
I think social change takes time, and I personally think, and I know Paul often writes about this, is that if you have a strategy that's a longer term strategy, then it should be robust enough for local fluctuations and things that will change now and again. Social change is something that you can look back on and you can comment on, but I think anybody that looks forward and says, you know, in the future the high street won't exist, and in the future nobody will go to school, they'll teach children at home, etc. We don't know what's going to happen. And this year has been interesting because changes have happened so quickly and so dramatically. Who the hell would have known that? And so try and predict what's going to happen in a year's time, I think, is foolhardy. I think it's better to focus on what you know, and you know, and look at the facts, understand what the investment is in the local area, understand what the market is in the local area, understand what the changes are in the local area. I'm going to go and buy houses in Norfolk if there's any left.
There aren't many, but we can still fit you in somehow, Richard. Probably quality person like you.
We'd be good neighbours, I can tell. Yeah, so personally, I'm not a great fan of trying to predict the future. But having said that, you know, I think, for example, we won't do any commercial or mixed-use developments at the moment because of the challenge with commercial. And there are things that you can do, decisions you can make that are in the light of changes that we're seeing or things that we're not sure about. So best to bet on what you know as opposed to what you think.
Yeah, and really, as you say, each of you reiterated so far, check out. It's all about the clever bit with investing is understanding that local market better than anyone else.
Yeah,
that's the key. Yeah. Nicholas, you've been very patient sitting there on your green screen. So what do you think? I think this comes back to the kind of real doom and gloom potentially about commercial at the moment, but there is a little bit of a light at the end of the tunnel for commercial investors potentially, particularly in really, really tough supply and demand areas for housing, because of the permitted development right changes. Do you want to kind of explain what they are and talk through where maybe you're not quite as sad as John might have made out earlier?
Well, yeah, absolutely. I mean, what's interesting with the proposed permitted development rights, and they, you know, a lot of them are yet to be 100% formalised, but the essence of them is, you know, extending on things like the PD rights that have been in existence for a few years now, like the office to residential conversions and, you know, bigger extensions on your home and all these extra PD rights that they've kind of afforded, you know, homeowners and property developers alike to recycle old properties. You know, it was the sort of rundown, not always rundown, but often rundown offices that were kind of getting put out of business by these grade A offices being put up in town centres. You know, I operate in the southeast of England, in the Thames Valley areas, and places like Reading where it's got Crossrail. There's big new tower blocks coming up with beautiful serviced accommodation and serviced office accommodation and shared office accommodation. And, you know, you can take whole floors, you can take a cubicle. And those kind of office spaces are making it harder for smaller serviced office spaces or smaller offices to kind of compete or compete for tenants. So when they get a bit worn down, you know, they weren't spending the money on them because it needed huge refurbishment costs to bring them up to the standards of these other incredible buildings that are being built around. So recycling of commercial property is key with these permitted developments. You know, just leading on from what John said there completely, you know, ultimately there's going to be a lot of a lot of problems in the commercial world, a lot of vacancies, and that's, I guess, very sad to see. And whether it's the social change that you guys have been discussing, that's maybe people are going to be going to offices less, going to the high street less. The high street's been in decline for a number of years in any event. Amazon, I think I read yesterday, bought 8 new Boeing 747s or whatever it was to be able to deliver their goods because of online shopping. So all of this is kind of compounding into the government, seeing that. And, this is a sign that the government is saying, this is happening, guys, backing John up here on, the commercial problems that, that are out there or will be out there. The government's seen that a long time ago. I want to say a long time ago, a month or two ago. And they've already started rushing through these permitted development rights to allow us to potentially change shops or shops on the edge of town centres without full and rigorous planning permissions. And the same goes for the sort of the office to residential market. That's being extended by things like extra floors. So I think it's due to come in on the 1st of August. And again, to watch this space, it's not set in stone as far as I'm aware, but I think it's the 1st of August they've indicated. And buildings over 3 stories, so 3 stories or more, I should say, will now be allowed under prior notification, which is this permitted development route. It's a more lax route of planning. They will now be able to add up to 2 stories extra, provided the overall height of the building doesn't exceed 30 metres, I think it is. And also the building has to have been built between 2048 and 2018, I've noted down there. So there are some requirements coming out for it, which is good, which means it's definitely happening. That works brilliantly for me. Incidentally, on our site in Newbury, we've got a 42-unit micro studio scheme there. We've applied for planning twice and appealed twice and been failed for a single story. Now we can whack in a double story under permitted development. So,
there are some positives coming out. And just on that, Nicholas, one of the things that I picked up is that, do you think they're going to tighten the building regs a little bit more? There's a real fear, and for anybody out there that's maybe thinking of kind of looking at doing an easy conversion, if you like, there is a point about and a worry, and I think it's fair, about the quality of some of these conversions. I know that some have been done on a window basis, and actually I did a program on that with Radio 4, and they weren't as bad as people necessarily thought, but they've stopped that now. Do you think they'll tighten building regs? Because I think permitted development right is all very well, but you still have a lot of building regs, and you should still be providing quality for the future. Otherwise, you're going to increase your maintenance and refurb costs in the future, surely.
No, absolutely. And I agree the quality needs to be there. And I think, also, can I just ask, sorry for the earlier cut off, everyone. Can we ask lots of questions in the chat to everyone?
Yeah, we do have a huge amount of questions.
Do we have a huge amount coming in?
Yeah.
Excellent. Okay, we'll keep them coming, guys. We want to keep Kate busy at the Q&A at the end.
We've got a lot. You can send us some more, but we're going to struggle to get through them all already.
Right, fine. That's good. I'm glad that they're coming in. Keep it going, guys. So, to answer the question, Kate, I think building regulations are quite tight, to be honest. I don't think the issue is necessarily the building regulations themselves. I think it's maybe the people adhering to those building regulations and just not doing building regs for a dodgy conversion. That could be issues. Obviously, that's extremely bad practice. It's dangerous. It's, potentially risky and criminal to your tenants to not build to an extremely high quality. So I'm not sure building regulations themselves are at fault. They've got tighter over the years with things like Grenfell. There's much tighter fire regulations. There's all this stuff in place. But in terms of, the people that are doing these conversions, it's important to know that they should be done to new build standards, and that's what the building regs generally allow for. So you need to be a bit careful when you're taking on a project that it's done correctly. Things like acoustic flooring and acoustics between the buildings is a contentious point, as is windows and all the new kind of eco-friendly stuff and U values and EPCs and SAP calculations. All this stuff's
and I guess size as well. So there's a place for the micro, but listening to Paul and Richard, it's also about thinking that people may need that office space at home. So maybe less is more in the future, perhaps.
Yeah, I mean, live work units are cracking, and we, when we design our units, which are micro studios, they're only just sub the normal studio size, and they're extremely well designed to have office and desk areas. It's kind of I believe in good quality space design as well. And if you build to a high standard with good quality space design, you can create something that feels twice as big. And of course, in the right conversions, I think it comes down to picking the conversion. You can have a lot of high ceilings, so you can create this voluminous feel. Some of our units and build sites have had mezzanine areas, for example. So although the overall small, floor area down below might be only sort of 20, 22 square meters, we're adding another 10, 15 square meter mezzanine, which creates it, over and above a normal studio, in fact. So there's lots of opportunity with offices. I think going back to the sort of PD rights question there, great to have new, floors being added to some of these bigger buildings. There are, shops and all this kind of stuff. But the problem with planning has always been at the local authority level, and that's the issue. They still have reason to refuse some of these applications under the current PD. And these new PDs will be the same, and it's very much under the prior notification route, where you have to sort of prove highways, contamination, flooding, noise contamination, acoustics, that kind of stuff. So, the council could quite easily say, we don't think you've got enough parking requirement, or, you've got too much parking requirement. They can make their mind, they can do what they want. And they do what they want. Reading Borough Council don't want any car parking. Newbury Town Council want, which is West Berkshire, they want the full new build 0.75 per space for every studio parking. So, they make up their own minds. And actually, if they want to refuse it because they don't like it, they're still going to try and do that. You may well get through on appeal, but they can still make your life difficult. So it's not a foregone conclusion, PD rights. I just hope the local authorities take the advice from the government and take the message from the government that we need more housing. We need to loosen these things up to create more, good quality accommodation, of, like you say, reasonable size.
And I guess the last couple of questions, maybe bundle them together a little bit at a time. Best opportunities you think for residential developers, and then to kind of tag on that, where do you think HMOs sit in the future as well?
Yeah, and I think, we've touched on a couple of the good opportunities here is the relaxed PD rules are a massive, massive, massive opportunity. Office to resi has been a huge opportunity for the last few years. If you've got existing buildings, you can get another 2 floors without any planning. That's like unheard of in planning history. Our building's 10,500 square foot. So what's that? It's roughly 3,500 square foot per floor. So we've got 7,000 square foot potentially of rights to go and build these floors subject to the prior notification. I think the shops area, recycling shops that aren't doing well or not in prime high street areas, on the fringes of the high street or the ends of the high street, stuff that has always maybe struggled to let anyway, those will become ripe for picking for investors to go and recycle those into good quality residential accommodation. And I think, good stock coming to the market is going to help. I mean, the PD rights really worked the first time round, in my opinion. There are some horror stories of badly converted offices and whatnot, but I think, like everything we've discussed today, that's not the majority. Building regs still come in and kick in at new build quality. So, as I said, I don't think it's the building regs issue. It's down to the developers doing it. And PD might attract more of a mainstream market that isn't quite so professional. So I accept there's a concern there, but I think that's for the local authority to deal with. And I don't think it's widespread, as much as there might be the odd bad story out there. So I think, the opportunity is there to, help the housing market, recycle stock, inject more people into an area. And if the high streets are struggling, you're better off having, 60% the size of the high street with more people that live on it that are going to use the shops than 100% with half of the shops vacant, for example. So, I think it's an interesting market and one that I'm looking forward to getting stuck into over the next few months.
Yeah. And then we have actually got a lot of questions on HMOs. So I don't know who'd like to pitch in on this. Do you want to just tell us your view? So are HMOs worth it? There are some questions on how do you deal with self-isolation. So we produced industry guidance to the Home Buying and Selling Group and Lettings Industry Council, and we have a whole sheet which explains how to deal with the current rules under HMOs. So if you go onto property checklists, you can find that in there. Give me a nudge if you need some help. But we have actually done all the guidance on that, so I can cover that question off. But good market, bad market for HMOs for the future.
Yeah, definitely. I'd say I'm not going to go into the detail of specifics of running the buildings. The councils also, the individual councils also give good advice and guidance as what they kind of expect. Go to Kate's site and download all that info there. That will give you some really good practical guidance on running and managing things in the current climate. But in terms of the general market, I think I'm going to reiterate a little bit what Paul said and what's been covered so far is that, it's all about the area, and people, when they go into HMOs or consider investing in them, they also look at, is this area oversaturated? That's a big question that people have. How can you, quantify the demand? And it's exactly the same process and due diligence that you'll go through as you would with a single buy-to-let. It's looking at the infrastructure, looking at the offices and buildings and industry and professionals, or if you're doing a professional market that's in that area. If it's a student HMO, of course, HMOs is a broad term, but depending on what you're using it for, students obviously, a little bit of a concern in the student market. I'm not an expert in student HMOs. I don't really like that model. I don't like the cyclical model. I don't like the dependence on universities and what they decide to build and how the way they house. It's not my kind of investment. I'd rather do the professional market, which is then just driven by basic supply and demand at a different price point to people that may be able to afford a one-bed apartment and all the bills, which could be sort of 1,500 quid in the Thames Valley area, could be anything from 1,000 to 1,500 quid by the time you add in all the bills. Okay. The HMO market, and if it's a good quality professional HMO, which is some of the ones we do, good en suites, really nice big kitchens and living rooms, and communal areas. It's all about the price point and hitting the right price point with those, where people actually in this time, if there are big layoffs, if there are people getting laid off in certain areas that were renting a 2-bed flat or a house or whatever, or owned a house, they may consider selling and downsizing. Maybe they split up with a partner during COVID. I've heard a few stories there where people haven't had the best marital experience.
Okay. But so you mentioned the student market there. That was another question. Has anybody got any thoughts on what's going to happen in the student market now and how to survive it?
It'll come back like anything else. Whatever we're looking at now is short term.
I don't totally agree with that, Tony. I don't. Neither. Some of it I don't think is short term. I think, for instance, people working from home, for a lot of people, it will be long term. It's a better quality of life. It's better for the environment.
Yeah.
And they're saving, £5,000-6,000. Some of them not travelling to London. So I understand they need to go to London now and again, or wherever their office is now and again to see people. I accept that. With universities, you would have thought it is short term. I agree, Tony. However,
but is it though, John? Because I'm hearing that some of them are in financial difficulty.
It's funny you should say that, really, because my stepdaughter, who's just got a second degree in law, she's hardly seen her tutor in 2 years. In a year, she did it in over a year. Basically, they're either off because they're off on strike this year, or that it's COVID. It's been a disgrace. She's paid a fortune of loads of money out, and she's hardly seen the tutors for more than probably 20 days in the year, and that's disgraceful. And I think actually, if people are going to university from home, work from home with it, like Open University, of course, is what that is, isn't it? Maybe, everyone's had, all these universities have had a fantastic time with this accommodation and so on. They charge a fortune for, maybe the tables will turn, Tony. Maybe it will be different, Kate. But I certainly, if I was investing in university accommodation, I'd be very careful at the moment. Take Sheffield, 80,000, university students in Sheffield. It's a massive. If half of those don't turn up in September, that's a massive loss to the city, massive loss economically.
Yeah, I think my nephew's going back there, so they've got one.
Well, that's something, isn't it? 79,999 to go.
Absolutely. So we're all right. So
just a quick comment. Just a quick comment on that, Kate. It also depends on what type of student accommodation you're talking about, because there's a big difference between buying a house next to a uni and renting it to 3 students, and purpose-built student accommodation, which quite often is new build. It comes with a rental guarantee, and it's more commercial property than it is residential property, because obviously somebody can't buy it to live in it. You can only ever sell it to a landlord. And the value is heavily based upon the yield, almost solely based upon the yield. So that type of thing you need to be a bit more careful with, because quite often the rental guarantee might be 5, 7 or 10 years. Once it runs out, what do you do with it then?
Yeah.
And is there actually a secondary market for it?
Yeah.
So
Yeah. And just leading on from that, we're getting a lot of questions about what's going to happen in the commercial loan market.
Well,
there's your answer. You heard it here first.
To get the answer, ask the question: what lunatic is going to lend anyone money on a vacant commercial property unless it's got an alternative use? They won't lend. Simple as that. Unless you've got a lot of other assets and they're lending on those other assets, not on the commercial property you're buying.
And that's going to, John, isn't it? That's going to help tee into the PD rights for developers.
Yeah, but what you've got to remember on
it.
PD, Nicholas, and you know this, and you didn't mention it, but I'll just remind you, is that not every property that you can do PD on, you should do PD on. Because it doesn't suit the area, it doesn't,
100%.
If it's very commercial, you might be able to develop it, but who's to say you can refinance it at the end if it's in a very commercial area? People like Richard will say, sorry, but we don't want our clients to lend to borrow on it because it's not acceptable lending. You've got to be super careful, and just to say, oh well, yes, you can develop it doesn't always mean you should. Is really what I'm saying.
No, and the PD under B1C is the light industrial, isn't it? That's been in for a couple of years now, I think, and that's not really taken off at all because most light industrial's on a trading estate and it's not suitable. So it kind of fell a bit flat, didn't it, that one?
Yeah. So another quite good, it's a good question, this one, because it'll help. I'm trying to pick out questions that mean I get as many answers as possible. So this is from a lady who's been made redundant, sold a property a week later, built up a large amount of equity, which she's now looking to invest and start a career in property. So if maybe I can have just a couple of minutes from you each so we can get through as fast as possible. What would you suggest is the best strategy? And she's got buy-to-let and flips, but there are lots of other things they could be doing. So you've each got 2 minutes. Paul, we're going to start with you.
Right. Yeah, okay. I'm going to be a little bit harsh in a response they probably don't want. Go and get another job.
Yeah.
Don't quit your job to do property when you're just starting in property.
Yeah, she didn't have much choice on this one.
Well, no, I understand that, but I would highly encourage her to go and get a job.
Okay, and that's an important point.
And you build a property portfolio on the side until it is substantial enough to provide the income she needs. We deal with a lot of people who have done exactly what she's done, and that's usually our first thing. We say, look, you don't want to. Sorry, I didn't hear how much money was it that she has from the property sale?
We haven't got that information, but she's just said a large amount.
Okay, well, look, it depends how large is large, because that's subjective.
It is.
But yeah, look, we deal with a lot of people who, have inherited 50 grand and quit their job, and that's just madness in my view. Property is a slow burn. It's going to be very difficult, especially as a beginner, to turn over that money quickly enough to make it a full-time job that's profitable enough to be a full-time job. Yeah. And I think most people with any experience would agree with me on that.
Okay, Richard, so I'm going to cut you 2 minutes there. So that's good bit of advice. Go try and get another job first. Richard, where are you heading to?
Well, I would say, similar to Paul, I would say don't do anything straight away because, too many decisions are made quickly. And you come to regret them if you haven't done your research. You're not clear what you want out of it. So it depends what she wants to get out of the investment in the future. There are things that she can do with the money short term while she's deciding on her own strategy. So she could invest it in various ways, various platforms, so that it grows and generates additional income while she's planning her own strategy. But I would say take your time, do your research, talk to people like Paul, get advice on what the options are, but slow down. One of the things.
Yeah, I agree.
In haste are rarely good decisions.
It's like that money's burning a hole in somebody's kind of back pocket, isn't it, really? Albeit a very large one. John, what's your just quick couple of minutes? That's 2 minutes.
I hate agreeing with Richard, although he's a good friend of mine all the time. Now, it's not.
Another one themselves and don't really have much track record. But, I would like to iterate that, good education and the right education is critical. And, there's lots of low-hanging fruit out there, and all of us, including you, Kate, we put out lots of good ebooks and books. Property Forum, we've got Property Tribes, a good friend of ours. We're all out there giving good information for free to get you to a certain point. And I talk about this in all of my talks about this sort of funnel of education. Get the low-hanging fruit, but that'll get you so far. But then, you've got a little bit more knowledge. You can go to the next level of books and maybe some very well-researched courses with good, legitimate people behind them.
And that's actually why you guys got together, wasn't it? Because you were sort of really frustrated at some of the rubbish, and
absolutely.
Testament to you guys. You do. What I like about this is that you're actually doing the projects here and now. And when you talk a lot to the guys that are up there talking and telling you how to do it, actually quite a lot of them are. Well, some of them are near bankruptcy, or they've got high court cases going on, and those sorts of we've got another quite specific question, actually, which I quite like. I have a 75% loan-to-value mortgage. If prices fall by 10%, then the mortgage company could demand 10% from me, which I don't have. Do you know any lenders that don't have this clawback? And I guess, is that actually something that they need to worry about, or do you think the rules, if you like, and what the government's doing will help them through this period of time?
Is that mortgage in a personal name or via a limited company?
I'm going to assume it's a personal loan, Tony.
Yeah, and I don't think it really matters. My understanding, and I am the principal of a mortgage brokerage, is that the vast majority, if not all mainstream buy-to-let products, they cannot ask for a revaluation. I think a lot of people assume that they can, but most cannot. It's usually only a commercial arrangement, which is quite often, and that's not necessarily to say for a limited company, but more so for a larger landlord that might have 20 properties and has one lender across them all. Usually in that case, they can ask for a revaluation. It's more of a commercial loan. Whereas with the vast majority, as I say, if not all, I'm not sure if it's all, but I know it's most of them, they can't ask for that. And that's what makes it so low risk, because it doesn't really matter if the value falls by 10 or 20%, so long as it's still rented and you're confident it will recover.
Okay. And if that's so, but can they do it if it was their own home?
No, absolutely not. Even less so.
As long as they keep up with the payments. I mean,
as long as they keep up with the payments and the mortgage term is long enough.
That's why what Paul does is so good, because to be honest with you, bit boring, but it's very good. And the reason it's so good is because over the next 20 years, the market's gone up 5% year on average, and we know it's a micro market and so on. But at the end of the day, it's super safe. If you're not an entrepreneur, if you don't want to be a trader or a dealer or developer, then what Paul offers is so good. It's so strong because it's safe, and for that main reason that even if the market goes down a little bit, no bank's going to start pulling it off you as long as you keep up the payments on the mortgage, which is the same for any mortgage.
And we are going into this recession with 20% of people renting. In the last recession we went in, and it was just under 13%. And
that's very interesting. I'm going to write that down.
Private rental market. We've got another one which is quite good here. Which is it a good idea to buy new builds off plans in this situation?
Can I start with that one?
Yeah. I kind of sensed you were about to.
No.
Have you got some for sale, John?
Don't do it. And the reason you don't want to do it is because you don't know if it's not going to be ready for years. Say for a year, you don't know where the market's going to be in a year's time. If you want to do that, go and put some money on a horse, or go and put it on the stock market.
Okay.
Yeah, look, I disagree with that. I think it all depends on the individual opportunity. If you're buying a good property at the right price in a good area, that for example, I'm currently committed to buying 3 off-plan properties personally, and because of their locations, I'm very confident they're going to be worth the right price, if not more, by the time they're done.
With all due respect, you are not the average. You're not the average investor. And the average, with nothing is average, I appreciate that, but you're not a newcomer investor. And to be honest with you, why would you commit to any property if you don't know what it's going to be worth in a year and a half's time?
But to be fair,
again, I think it depends on the individual opportunity.
Advise people who are maybe new into the market. So as long as it's possible if you've got the right advice. Maybe that would be the other one. I'm going to move on to another one, which kind of helps with this. So yes or no is the answer to that one. If you're buying with cash, and I'm quite interested to your answer on this because I know what mine would be, on average, what sort of percentage discount would you expect off the price?
Why are you buying with cash?
Yeah, that's a very good answer. We'll go to that one second. But my understanding is your chances of getting a percentage off at the moment, it doesn't matter whether you got cash or not. The market
the one thing I always say to people in a market that's going to get tougher is actually it's almost not the best price that should count. It's the best buyer. So at the moment, okay, everyone seems okay, but going forward, it's the best buyer, not the best price, because you want certainty your deal's going to happen. If the market starts to slide, you need to make sure you've got a buyer that will proceed. And obviously, if someone is cash, much better chance of proceeding than if someone isn't. However, if you are a cash buyer,
but doesn't necessarily mean you can get a deal at the moment with the market.
No. But going forward, we always advise anybody that if there's two buyers, one at more money than the other one, one's cash and one isn't, which one do you go for? You go for the cash one.
Yeah. And Tony, you made a good point there about why. So I think it's sometimes good to buy with cash if you can get a discount. But there's a real thing about holding with cash now as to whether that's going to pay back with such low property price growth that's built in naturally. Do you want to explain that to people, Tony?
Okay, so there's good debt and there's bad debt. And with interest rates so low, even if you're borrowing 50% loan to value, you're probably going to get a greater turn on your money by using half of your cash as opposed to all of it. Once that cash has gone from a liquid to an illiquid asset, you can't spend it again. And who knows that you may not be able to mortgage that property when you want to. And there can be restrictions on if you mortgage in to take the money out and so on and so forth. So once again, it depends on the circumstances, depends on whether you're looking to grow a wider portfolio. But I'd say don't buy with cash unless it's really going to be your principal private residence and you've got plenty of other money lying around and you can't be bothered to take a mortgage.
Yeah.
I think it's almost an impossible question to answer as well, because I think far too many people go into deals with a set criteria of I need X discount to make this good. But that's, again, it doesn't apply across the market.
No.
Yeah. And Nicholas, the one for you, which is the best channel to find for commercial property?
The best channel, was that?
Yeah, where do you go to find commercial deals, basically?
I would say the best tip would be to make good friends with your local commercial agents and surveyors. Now, commercial agents, and John, it'd be interesting to hear your opinion on this, is they tend to be a lot worse at promoting deals than residential agents.
I personally call them all lazy, and some of them are my friends, but I still
extremely
call them
lazy.
Compared to the residential agent, they're not very proactive.
No, and they don't market on major portals like Rightmove, or rarely, because there's an extreme, very high cost for that. So they stick it on their own website, they send it to their local database, and that's about it. And they hope to get a deal, or they stick it on Estates Gazette or something like that. So that's a port to look at. I would say definitely the biggest tip is drive around the city, see what your target city. Again, sourcing should be knowing your strategy, knowing exactly what you're looking for and being laser focused on that, sending out those requirements to all those local agents that are relevant, meeting them all, becoming their friends. That's the same for residential as well, by the way, but for commercial, it's even more impactful because they're just lazy. If you've been in the door that day and they get something in a couple of days that matches your criteria, regardless of who's on their books, they'll probably call you because they're like, I know this guy's looking now. So it's even more important to get on their books, speak to them, make good relationships. Look for properties that are for let on a commercial basis. You might well find, that's a good tip that I use all the time, is it might not even be for sale. It might be for let, or it might be all inquiries. And that's where you can go and ask. It might have been sat on the market for 6 months vacant, all these, even more so in the coming months. More of a distressed seller. And remember, with property sourcing, you're also looking for the seller, not just the property. It's a combination of the two to get a good deal. So for let can really help you find distressed sellers more easily. Hopefully it's been vacant and they're dying for you to take it off their hands.
I have to say, one has come in, and this is a comment, really. Fantastic haircut, John.
Thank you very much. That's lovely.
Is that your wife, John?
That just tickled me. I
£25
just
was
thought
worth it. That was all worth it. Makes it all worth it.
I've got another question, which is about the residential development market. How's that sitting? Richard, do you want to come in on that?
Well, it's very interesting.
You're not Richard.
Sorry, I misheard. Sorry, Richard, carry on. Sorry.
You got a lovely haircut, so you can just look at everybody and do side to side. But Richard, do you want to answer that first?
Carry on, Richard.
Thank you, John. Kate, what was the question? Where does the residential...
Yeah, what about the residential development market? So getting into physically developing properties for resi, is this sort of good time? What are the issues to think about?
I think, it's the market that is being affected by what's happening at the moment in a number of ways, and it depends on where the development is in its stage. So if the development hasn't yet started, then it's not too bad. If it's midway through and it's almost finished, then it's uncertainty about the exit because of sales and so on. We have a strong feeling about the residential development market in that whatever happens, the country is still going to be short of 300,000 houses or units, and so they need to come from somewhere. Everybody needs somewhere to live, whether they're going to rent, whether they're going to buy. They need somewhere to live. So we believe there's always opportunities in the residential development market. The challenge is choosing the right opportunities. And I think if we refer to all the things we discussed earlier, they inform, how to go about it if you want to get into residential development. Choosing the right area, looking for areas of regeneration, targeting your market at a particular audience, and so on. And those things will always be true. So I don't think it's a bad time. It's probably not a good time for your first development. I think if you know what you're doing, it's fine. If you're about to start doing residential developments, then I would perhaps wait a bit and see how things go, because the more certainty, the more likely you are to succeed. I think that would be my general thought.
And back to the lovely John with his beautiful haircut.
Thank you. I think what Richard said is absolutely right. If you're 3/4 way through a development, get it finished as quick as possible, because then you can get it sold this year, hopefully, and I don't think you have any problems. You probably won't have any problems the first quarter next year, but after that, if you're about to start, if you've got an out before you have an in other words, if you've got a second option, which if they're small properties, it may well be to rent them and then refinance them. I think that's fine. But if they're bigger detached ones, I think I'd just be I just want to see where the market's going more first, and just be cautious. Interestingly, the one thing I was going to say was that I don't do a lot of land, but I got friends of mine who do, and sometimes I get offered land and I pass it on to them, and all of them are being very negative on their prices on land. So if you have agreed a price 3 months ago on land, I expect if you go back and renegotiate that, you won't find that the agent will find another 3 people who will pay more than you will. Yeah. So I would just be wary. Just be wary.
Okay. And Nicholas, one for you. Where do people find out about the PD rules, and where do they look for the confirmation of changes?
Obviously there's lots of commentary out there from the likes of Savills and Knight Frank, and all the major agents will be posting information. But ultimately, you can go onto the planning portal website. I think it's planning.gov.uk, something like that. I'll quickly Google it.
There's the planningportal.co.uk.
Planningportal.co.uk. That is almost certainly going to have updated plans once they're available. But good old Google, it's not rocket science, not a hard question to answer, I'm afraid. It's out there, and it'll be out there in the public domain, and fairly straightforward. The PD at the moment is fairly straightforward. There's only 4 criteria. But what I would stress to anyone looking at these PD, it's not a blanket go out and do stuff and just crack on. There is stringent building regs to new build standards required. There are these 4 criteria, and you still need a good planning consultant to make sure that before you exchange on something, to make sure that you've got these elements in order and you've got good reports for highways, contamination, land, acoustics, noise contamination before you put in your prior notification. Do that work up front. It'll save you a hell of a lot of money and time if it goes wrong. If you're prepared and you give the council a reason to not refuse it, and you've done good quality reports from good quality, well-known consultants in the industry for the various fields, the council will find it hard to refuse it.
Just two very quick points on that. The two things that people get caught out on are cycle. They have to supply cycle storage, and if of course if it's a building with no external space, that can be very difficult. And the second thing they get caught out is bin storage. So they're the two things the council can turn you down on. So be very careful that you've got both covered.
And this is a real area, I think, where some stuff you can, as Nicholas was saying earlier on, educate yourself by reading.
Yeah, absolutely.
All the free stuff, but this is where it gets into real specialist. And
personally, I would never buy an office building without already having PD on it before I bought it.
Yeah, okay. And I guess on land, one of the questions is, so I mean, I'd like to look for a plot of land, build a few houses, one for me too. Are we going to see some really good prices coming in? So this could be a good time over the next 12 months to get some land, sit on it for a little while, and then start building as we start coming out. Is that a good strategy, or have I crashed and burned myself already? Richard, what do you think?
Well, we don't fund land deals, so I'm not an expert in buying land, but I feel like you have to. Well, personally, I'd have to be fairly certain that it will get planning permission in the future. And around here and areas where we work, the planning decisions can be pretty unpredictable. So I think if you get good advice from a planning consultant who knows the area and they have a pretty good feeling about the likelihood of you getting planning one day, then it's probably a good time. But planning rules change all the time and planning departments change all the time. Personally, it's not a risk that I would be willing to take, but people do, as like John says.
And I perhaps didn't. So my understanding on land is you should always buy when it's got outline. Mostly when you're looking, it's got outline or planning permission already.
Well, if it's got outline planning permission already, then I think that's fine. But if it doesn't have any planning, which is sort of strategic land purchases, then I think you need to know what you're doing.
Do you remember those days we were talking about a property investor show early on, where people were selling those plots of land which they just split up agricultural? Do you remember that?
Yeah.
That was like one of the biggest shark things ever, and I don't think ever one of those plot deals has ever come to fruition.
No.
The scary amounts of money that those guys made.
Yeah.
We've got another one. Somebody just trying to look at these ones coming in. Done that. We've got somebody saying basically with the home moving model, we have just sort of heard this news on Huawei maybe being kicked into touch now, or definitely kicked into touch. Is that? I mean, do you have a sense of something like not being able to do 5G and that kind of thing? Is that really going to impact that badly? Is it something investors should be worried about, or is it noise we can ignore?
I think it's noise we can ignore for the time being. But most people.
I think you're going to expand on that there.
Oh, I can't expand on it. Okay.
So I could look at some more questions. Go ahead, Tony.
No, look, 4G works pretty well. And to have our own infrastructure is not such a bad idea. No, I shouldn't worry about it too much.
I think part of the problem.
John, Nicholas, you're sitting there on your big pipe with all.
I think part of the problem, Tony, is people like Vodafone have already geared up massively in terms of staffing levels for 5G and delivering it. I know there's a Vodafone HQ up in Newbury, so there is an issue there that there might be layoffs, and it might lead into layoffs. A lot of telecommunications companies and everyone down that entire chain. It's a big industry. Could affect jobs. So I think that's the risk, but who knows? I think you've got
what I would say, I think it definitely affects, and we had a sale fall through in Norfolk the other day, apparently because he tested the broadband and it wasn't quite good enough for his business. Now, whether that's an excuse or not, there's ways of boosting these now, I know, and Nicholas knows all about it. I haven't got a clue, but so I do think that broadband, if people working from home, it is important to people. And of course, if you're moving out and buying a bigger house, you can afford to have some fancy booster, probably, some serious stuff put in it. But certainly that's the benefit of being in the city, isn't it? Is that the broadband is normally a lot better than it is in the country.
Yeah, yeah, and
But
I know some surveyors actually take that into consideration.
Yeah.
So they certainly will record that on their services. Richard, did you want to come in there?
Well, yeah, I was just going to say, I probably disagree with Tony unusually. 5G is much more than faster broadband. It will enable all sorts of services and use of technology that we probably can't even imagine today, and they will be coming in 3, 4, 5 years' time. So in order for the country to be competitive and post-Brexit to lead in certain areas, particularly the related to technology, I think it's important that we are, at least on a par with our competitors from a 5G point of view. So I think it is serious, and I think it is important. It's not directly related to property, but it will impact the way our society develops and progresses and how we the market.
That I would agree with.
Well said, Richard.
Thank you.
Right, so we're kind of coming up to the last 10 minutes. The one thing we don't really do on these calls and still won't is sales pitches. When you go elsewhere, you get 10 minutes of information and then the rest is just a massive sales pitch. But do you want to each just maybe highlight and say how, just not as a sales pitch, but if people want the help, what's the help that you can give them? Paul, do you want to run off first there?
Yeah, of course. So, to tie into what we were saying before, there's a lot of uncertainty in the market at the moment. People want some guidance or at least a sounding board on how best they can go about things confidently. And essentially, that's what we do for property investors. So we help people set goals, put in place a strategy for achieving those goals, do the research and due diligence on sourcing the right properties in the right locations. We finance them, we manage them, and then we help people review and reinvest as time goes on. So if anybody has any questions or any uncertainties, they'd like to go about investing in property in a relatively passive way, unlike John, who'll help them with property development, we help people take resources and invest them and not necessarily create a second job. If anybody's interested in exploring that, then we can help them.
Okay, and I know you'll do some better help for free as well, won't you? And
yeah, absolutely.
And
the whole start of the process is free.
Yeah, one of the differences is you're not just a broker; you're actually financial advisors, and that's right, isn't it? That is a critical thing. Is linking is that investors spend far too much time looking at a deal as opposed to looking at it. I've got 50 grand. Where's the best place for me to put it? If you get the financial advice first, that'll help you understand whether a property deal is correct or not.
And you've hit the nail on the head there. I'd say that's probably our biggest point of difference to most other property companies, is we're much less about the properties and much more about the person's strategy and their goals.
Yeah, and you're regulated.
Yeah.
By the Financial Conduct Authority. So, and have to have qualifications, which others don't always have. John, do you want to kind of explain the sorts of things that that you can help people with?
Well, I'm a bit selfish because I'm busy doing my own stuff, but but I do a little bit of mentorship where it's called acquisition mentorship. So people for 12 months they can throw as many property deals at me as they're looking at, and I can go through them with them. And go through it with them and advise them. Some people look at it a bit like an insurance policy, really, not to make a silly mistake. So that's one thing I do.
Pair of eyes is always wise.
Yeah, absolutely, and they can bounce things off me. Some contact me every other day, others contact me once every 2 months, and so on. So I do that. Also, I've got 3 seminars based on my 3 books. And hopefully we're going to go live again in London in September on those. We've got Zoom ones in August, and also I've just started. We're about to launch our high net worth listed property bond, which is a 5-year bond. So that's something that I can't broadcast because you're not allowed to promote it as such. But if anyone's interested, they can always come and talk to me about that.
Okay, cool. Tony, do you want to just explain why you are Mr. Essential to investors?
Well, whether investors, property, looking at tax, want to write their wills or anything like that, the number one question I'll ask them is why. People come up with a lot of things about going into property or not going into property, but the one question that nobody ever bothers to ask them is, well, why do you want to do it in the first place?
Yeah.
Good question.
Yeah. And a lot of the stuff we've had today, didn't get the chance, but it's why are you trying to? That person who said they'd been made redundant or inherited a substantial amount of money, Why do you want to spend it on property?
Yeah.
Once you've got that, then it's making sure they understand where they are, really where they want to go, and they've got the right, efficient business structure in place from the outset. Ultimately, not just with me, but with all of us, the only thing we really sell is that which we know and they don't.
Yeah. And there's 3 ways, aren't there, that you can be classed or you by HMRC. Is it property investor, property trader, and I'm trying to remember what the third one is.
Well,
Developer, isn't it?
Yeah. Okay. So
and they all attract a different way of taxing you, and I don't think a lot of people understand that. They think you're taxed separately to everything else, just as an individual buy-to-let investor. I think it's really misunderstood.
It is. If you're taking on properties where the sole purpose is to collect rents for 12 months or more, whether or not you're in a company or in your own name, you are effectively treated as running an investment business on a passive basis and will be taxed accordingly. If you're a property developer, the other rules apply, particularly for land banks. And if you're trading in properties, once again, there are a whole different set of rules apply.
Yeah, and that's if you're flipping and things like that. So it is. I think it's probably the biggest eye opener I have on the tax side. Richard, tell us about your crowd rules.
Well, without going through the full risk warning, I can't really promote crowd rules, but I would just like to say that within the sector as a whole, so within alternative investment platforms, this might be a good time to consider using them because it enables you to diversify your risk and put in less and therefore not put all your eggs in one basket. That's true for us as it is for our competitors. So that's a reason why I think it's something worth considering right now.
Okay, so pop over to the site and maybe just understand the model a little better, and because a lot of people don't, and I was unsure. I must admit, I was quite unsure of it from the start. Frightened the living daylights out of me, to be honest. But I have to say, when you meet Richard and you kind of look at the things he's doing and some others as well, then I felt much more comfortable with the kind of with the idea. Nicholas, you got. Sorry, over to you, Nicholas, before we lose them again.
No, not at all. Thank you, Kate. I mean, yeah, just from my perspective, we're developers first and foremost. We develop commercial buildings back to residential. We've also got a large HMO portfolio, and we're still buying HMOs, a professional grade, high-end, almost studio-like, good ensuite rooms. Ultimately, we're looking to work with private investors that want to invest their money on a hands-off way, in a similar way to Richard's platform. It's a way to invest in our development firm into a loan note structure, and we essentially then use that money to buy and develop properties, and we secure your money across multiple sites in our group. So as we grow, you grow with us, and the security actually gets stronger as you go. So some really strong returns available there, and lots of good UK-based security to secure your money on. So we're always first and foremost looking for safety for our investors. We're investors ourselves first and foremost as well. So we want to make we've created a product that we think is highly investable for very hands-off investors. I also mentor people. So if you're looking to get into office to residential conversions, HMOs are probably my 2 strongest areas, micro studios, and sort of general property development. Reach out to me at one of my websites, nicholaswoolwork.com, and have a look at the mentorship offers there. I do one-to-one mentorship. So again, it's kind of people that have come off the back of courses, hopefully good courses, and not the bad ones. But I can help anyone that's got a good level of knowledge already and can take it further. I'm looking for people that can, that really need the practical side to help, and a bit like John does the acquisition mentorship. I do a similar kind of product, but it's really helping people, isn't it, John? And it's taking that knowledge and turning analysis paralysis into action.
I think, Nicholas, I think the most genuine thing you can say about what you do and others like us is that we're adding value. Yeah. So whatever they're spending with us, which isn't very much actually, it's adding value, and people must remember that it's a big ticket item. Buying a property probably is the most expensive thing they ever do. Getting it right is brilliant. Getting it wrong can be very expensive and cost a lot more than what our mentorship fee is.
Oh God,
yeah, especially over the next couple of years.
Yeah, absolutely.
Yeah. Cool. Okay, so we are kind of nearing the end. Thank you so much for bearing with us. I know we've lost you all a few times, so I do apologise for that. But I'm hoping we've answered all of your questions. If you do feel a question you haven't answered, you can contact me at propertychecklist.co.uk. There's a contact there, and certainly on the market, that's the sort of things that I will be able to help you with. But you've got Paul on the finance and buy-to-let side. Nicholas will help you certainly on the development side. Richard, if you're looking at alternative investments to maybe hedge your bets over the next sort of year or so. John, very much kind of on the acquisition side, and of course Tony on the tax side. So I hope that despite losing you a few times, that was really useful and helpful. And we're going to be doing this again as well. Have you got the date for the next one, or is that coming up?
I think we have one penciled in, don't we, guys? Does anyone remember it?
Penciled in.
I
We're
do
very
remember
busy.
it.
It'd be nice if we knew when.
Over.
It's
Is it
sometime in
August?
we were going to do one in November, but we also got the big one in January, which we hope to have. Where, Tony?
That's at Lord's.
At Lord's
Yeah.
Cricket
Yeah.
Ground.
Yeah, bring
Lord
your cricket
Cricket Ground.
bat, bring your
Let's
pads. We'll have a little game.
End of January. Yeah.
So so hopefully, so we've got a couple more events, so do keep in touch. And as I say, if there's anything else that you need from the guys, just shout and ask for their help, because I know that's the primary aim of all of us being here today for you, free of charge.
So sorry guys, just what's probably worth mentioning there, that I just found the dates. So we were Landlord Investment Show at Olympia, pending that show proceeding, which at the moment it's planned to. So if it does proceed, that will be the next Property Summits event in the auditorium, and then potentially another one in October prior to January.
Yeah. And January, hopefully somebody will have found a vaccine and we can all meet up and not worry about this horrendous virus that's hit the world. But as ever, opportunities available if you've got the right thinking. So really, thanks very much, and look forward to seeing you again. Any comments you've got, things we can do better, always keen to hear those. So do let us know, and look forward to seeing you again. Thank you.